going on, Greg?
Hey Ash, how you doing, bud?
I'm doing well. I'm doing well. I'm man in the man in the ship. Mike's out in California right now, so I figured I'd fill in. Always a pleasure. What's going on with
Yeah,
you
no,
today?
all good. Not a whole
Right
lot.
on.
Just gearing up for the holidays, like everybody else, and just kind of the main feature here with lumber, outside of price erosion, is just the commodity fund short rolls here going into kind of the month that it looks like they're accelerated and they want to finish these before the holidays.
Yeah, gotcha. Just real quick for everybody that trades futures or whatever. What is the schedule going into the holidays here?
Yeah, let me. I'm gonna pull up our slide deck, Ash. So basically, it's normal hours this week. There's no early close on Friday because Friday's not Christmas Eve, but we do actually have a closed session next Monday, the 26th. So that's the official observed holiday, and then that's the same for New Year's as well, where New Year's Day is officially celebrated next Monday, the 2nd. So you'll be closed this coming Monday and then the following Monday for the holidays. That's it. There's no other shortened sessions.
Right on, right on. I'm just pulling up our picture on LinkedIn here. Got it. So, look at one of the interesting things. You got your screen shared now, so it's all good. That I wanted to talk about. I was talking to Greg Riley, a lot of Gregs today before we were on the phone, and we were going over the housing starts. Right? I don't know if that's something that you highlighted. The interesting thing that I saw was our completions that we were fighting to catch up to starts has now surpassed starts. So we're completing homes a lot at a lot better pace now. Right? Is that? Do you read anything into that, or what's your thoughts on that, Greg?
Yeah, so let me pull it up. I'll pull up the slide deck here. I've got, yeah, I send out analysis on housing. So here's your, what you're referencing, Ashley, is here's your permits, here's your starts, here's your completions, and we've had complete convergence. I remember back in the spring, the end of last year into the spring, we talked about how both permits and starts were getting way too far out over their skis as far as where actual completions was. So now you've basically converged in this 1.4, low 1.4 something area, which is positive, but it doesn't bode well when you look at, and I'm a big fan, actually, I don't like the seasonally adjusted numbers. I look at only actuals.
I'm with you on that. Yeah.
And so, I know we've talked about this, over the past 10 years, you look at the actuals. And so, the big thing, so here's permits. These are actual housing permits. And so when you look at this, here's aggregate United States. So here's total permits. And then it's broken out by one unit is obviously single family, 2 to 4 units, 5 units becomes your multi. When you look at single family and then just aggregate housing permits and then single family permits, I mean, you're officially from the high water mark of June of this year, we're off 35.3% on aggregate permits. Single family permits are off 48.2% from the high water mark this year. And so, what does that mean? I literally had to go back and look at my housing charts here. You're back to February 2020 housing levels. So, February 2020 was not clouded with COVID. COVID had just hit, so those
Yep.
numbers were clean pre-COVID. So all that tells us, from a demand standpoint, the bloom is officially off the rose, and you're just back to pre-COVID type levels in housing. And then
Yeah.
when
So
you
this
look
is
at
these actuals are great, Greg. When I look at them, so what it really tells us is single family uh, coming down a little bit, multifamily still kind of carrying the water for us right now.
yeah, you've had again this shift, and we've seen this shape up basically since June and July of this year. This shift away from single into multi. And so when you look at here's actual starts, the same kind of pattern develops. I mean, we're off 32.3% from the high water mark. And the high water mark in actual starts was back in April. And then when you look at single family starts, they're off, 44% off the high water mark. And again, you're back into those March February of 2020 levels. So housing, and again, we had, let me pull up one other thing. I know we're going to jump around here, Ash, but
Yeah, no worries.
and I forgot to delete some of these slides, but let me go back to, so the big thing, so this came out yesterday. This is NHAB, Wells Fargo Housing Market Index, builder sentiment, and here's actual sentiment versus the red dotted line is single family sentiment. You're collapsing back down to the onset of COVID, when everybody was at their darkest moment with housing, we're going to go to zero. You're basically retracing back to those levels. Now we know we're not going to go back to zero. This isn't going to be a repeat of 2007 through 2009, but at least for the first half of 2023, conceivably at least through the Q1 into Q2, there's a lot of work for this market to do. You're going to have to absorb a lot of negativity and then hope that you start to see the green shoots as far as interest rates moderating, going into a recession. The recession isn't as severe as everybody is anticipating. And I do think that, the first half of 2023 could be negative, but then by the time you turn the page into the back half, Q3, Q4, that there are better times ahead. So I'm not going to get overly bearish on housing. You just have to have more realistic expectations, again, of what we've come out of the last 2 years was not reality. The reality is we're going back to pre-COVID type levels. And, we know from a number standpoint that we're underbuilt and we probably need somewhere in the neighborhood of 1.5 something housing starts. But the reality suggests that even in the best of times, the best we could do is complete 1.3, 1.4 something. So from a demand standpoint, realistically, we're going to fall back probably sub 1.4, potentially into that 1.3 and a half, maybe even sub 1.3 before we begin to stabilize. But that should be everybody's expectations from a demand standpoint, at least the first half of 2023.
So great point. I wrote some notes down while we were talking. I had conversations with lumber buyers over the last few months, and it's hard to average down your cost of lumber in a down market. It's really hard to do it, especially, right? So one of the things I look at is mill production, right? And this isn't saying anything about mills. I mean, hey, look at mills when they are making a lot of money, they should make as much lumber as they possibly can make. That is just economics 101. You make as much money or as much lumber as you can with the labor you have and the inputs you have. When it trades off, you try to adjust, right? The one thing I think everybody has to realize, for every 100,000 housing starts that come off, um, that is a lot less need of about 2.5 to 3 billion board feet of production. I mean, that's just a fact, and there's not much you could do about that. And it's almost equally as hard for mills to chase the demand down versus the supply, because first of all, it all starts with small little things. We're going to take off that extra shift and we're going to try to announce X amount of production off at this place because everybody has hope. Everybody thinks things will be better. And mills made a lot of money, and which is great, good for them. And there's some mills in the South still making money. So it's hard to make a decision to shut stuff down. The other outlier there is, the Fed's still going to raise rates, possibly. Rates are coming down though, which is good. The actual long-term rate, which is good. There's rumors of some big home builders out there buying down rates for users. There's industrial people, or excuse me, there's big companies out there buying houses to rent back, which is a dynamic that was not in the 2007 to 11 market. So there's liquidity there. And I always look at, when I look at these indexes, I mean, a lot of the worst case news maybe baked in, right? So
Yeah, I mean, I think those are, I think your analysis on supply and demand, and I've always used the analogy of demand is the speedboat that can pivot on a dime, and change directions pretty quickly. It can absorb current market affairs, current economic analysis, Fed posturing, and adjust pretty rapidly. It's the supply component that's usually kind of the meandering ocean tanker that needs 2 miles to churn, where it can't make those quick pivots. And I hate to use this word, Ashley. I always call out my clients when they use it, the hope. But truthfully, my hope is that, unlike in years past, where you had an industry, a production side of the equation that's been heavily historically always heavily leveraged, where their free cash flow has always been a significant issue, and more heavily reliant on lending from banks and credit from banks. And so the last 2 years have repositioned the production side to build out their free cash flow to truly have mountains of physical cash, where, look, there's a cost of doing business, and that cost is significantly higher now with the float out in interest rates. But historically speaking, producers have never been in a better position from a leverage standpoint. They're so under leveraged right now that they don't need the banks to make decisions. So instead of having bankers make decisions like in years past, where let's increase economies of scale, let's lower our unit cost, we're going to run things into the ground. We have to have some, even if it's a loss, we need to have some kind of return. Now you legitimately could have sawmillers making sawmill decisions, which I think, the one thing with their technology like returns going through COVID, they've conditioned their shareholders that less is more. We don't need to produce everything under the sun. If we produce less, if we don't have all this organic production, we can still give you better returns. And so that's my, I'm going to go back to this word. That's my hope, is that genuinely they see that, okay, look at the demand data. You're not putting lipstick on this pig. Whatever COVID was, it's gone. Okay, so you have to, the reversion back to demand means, so make these hard decisions and curtail. If you don't like these prices, do you realistically think that the demand component is going to be your savior yet again? And when you look at the metrics, there's no metric out there that suggests that. So if you're at the supply side of the equation, you need to do the hard analysis. And we've said this, I've said this, Mike has said this. It can't just be BC production coming off. It's got to be Alberta. It's got to be Eastern Canada. It's got to be Pacific Northwest. And dare I say, it's got to be Southern Yellow Pine. If you don't like these numbers, the reality of what demand is versus supply, you have to rein in the supply expectations based upon realistic demand.
So let's address the $8 billion that's floating out there right now still, that hasn't come back to all these mills. That's the one real outlier for that. I think, I know Greg Riley brought this up a couple weeks ago, and he sees that as one of the big things, that 8 billion board feet gets negotiated back in Q1, which historically, over over all these countervailing duty and anti-dumping resolutions, 90% of that usually goes back to the mills, right?
Yeah, no, and again, I think, a year ago there was zero thought of a negotiated settlement. Why? You're at historically high returns, everybody's happy. But as you have, again, this reversion back to reality, and let's not kid ourselves, the sawmills have higher cost of productions in all provinces, not just BC, in the US, because those log costs, even though they're coming down, they're going to reset again on January 1st. You're probably not back to your cost of production inputs as far as pre-COVID. I mean, raw goods, raw materials cost more, logs cost more.
Absolutely.
So that definitely, I think hopefully puts pressure to negotiate some kind of settlement. And yeah, I mean, history shows you're going to get back 85 cents on the dollar on whatever's been collected.
Here's an interesting thing. Talking to home builders, and talking to framers and contractors and retail lumber yards, lumber has come off, certainly, and it's at a really affordable price relative to what the last 2.5 years were. A lot of other items in the home building cycle are still elevated, haven't come off yet, right?
Yeah.
And I'm talking siding, I'm talking roofing, I'm talking cement,
You know,
plumbing,
let me
all
see
the
if I
other,
can find this.
yeah,
I didn't put it in the, I meant to put it
which,
in the, I'll
which,
pull
which,
up a
which,
slide here, which you're
which
referencing.
my point to that is, Greg, I mean, if people ask me for my advice and I say, take it for what you're paying for it, um, I'm like, we're at some pretty low numbers for lumber and panel products right now. So if you do have business, some of these numbers are getting to a point, and where I'm seeing it as we're seeing multifamily jobs getting done. I know I've got a handful of buddies that are in the multifamily uh, sector, and all of them have had multiple jobs come through in the last week that they've booked with multifamily people. And here's the crazy thing: a lot of them are paying them well over today's spot numbers. You know why they are? Because they don't want to deal with what happened 2 years ago, where people took business and then didn't ship it right. And so what they're doing is they've got money in it, they're giving business. So I guess what I'm seeing is some decent stuff. Great. Here's a great chart. Talk to me about
Yeah,
that one,
yeah, and
Greg.
so I think this kind of drives home your point in that, I mean, just because lumber has collapsed to pre-pandemic levels, there's the misconception that everything else has, and the answer is absolutely not. I mean, your gypsum board, your concrete, asphalt,
Yep.
electrical, I mean, pick a lot of these other components that go into building homes, and they're still exorbitantly high. I mean, yeah, they're all moderating, but like that doesn't mean that they're all back. They haven't had this free fall that lumber's experienced. I mean, so the reality is when you look at structural lumber, and this is probably generous right now, 7%, you're going back into the model of supermarket type margins where 3 to 5% has been an historical gross margin for most lumber operators. And anybody that's been in this industry previous to the last 3 to 5 years, Ashley, and this and all everything you've done, you can make a pretty good living off of reversion of the mean type margins. You
Totally.
just have to know
Yep.
how to trade a bear market. That's all.
Yeah, and
I think,
you gotta be willing to
yeah,
sit a long time on some stuff. Yeah.
yeah, yeah.
Yeah.
And so, I know we're going to jump around a little bit here, but
I was wrong on the plumbing though. Look at plumbing and water heaters are actually down. I said plumbing and I was off on that.
yeah, no, it's interesting to still see. And then, so the other wild card here, and it's been a wild card in a very negative way, is the restart of China. They've run their country from a cash flow standpoint hard into the ground to prove a point, and it's backfired. So, at what point does China kind of relax everything, and become really the consumers that we've all kind of anticipated they were, a resumption of normalcy there, and that could be a very positive headwind. I'm sorry, tailwind in 2023 at some point if China starts to do stuff again.
Yeah, no doubt. No, I had one other note here. So we were talking about producers and consumers, and look at producers work their ass off to get their lumber to the end user, and there is a lot of moving parts involved in getting timber out of a forest, stripping off all of the other residuals, and then turning it into lumber, loading it on a car, truck, and sending it to destinations, right? And obviously prices are down. So the interesting thing I heard this week, let's talk about the people buying lumber and let's address the people that are running their inventories down right now, right? Because business is still okay, right? It's not great, but it's okay. So what I heard this week is there's a lot of these companies now going out trying to get companies to do VMI programs. They don't want to take the risk where they traditionally had buyers all over the place. They want mills to do VMI programs for them, right? And with rebates and all that kind of stuff. It's interesting how people want to transfer all the risk back to the mills a lot of time, because this whole supply chain game is about who do you want to push the risk to, right? Have you heard any of that out there this in the last week or two?
Yeah, I mean, I think the one thing I'm seeing is the jobbers, the guys that are consistently short are kind of loaded to the hilt with their reload inventory right now. And this is a shameless plug, but I mean, this is where you legitimately look at March futures here for April 1st needs and beyond, March, April, May needs, and that you basically, let's assume print's going to be 350 tonight, and I think that's a realistic expectation. I mean, March traded down to 62.60. You've eliminated the cost of carry in March, so you can start to accumulate here. But the one thing I'm seeing is that we're going to have contractual obligations moving forward, but I think that they're going to be reined in. They're going to be dumbed down, with the
What
idea that less is more. And so kind of going back to what you originally said, actually, what I'm seeing is people, I think, still have historically low inventory levels, but the demand component has fallen off more sharply to where, all right, I thought I had coverage through, let's say, the first to second week of January. At this current takeaway pace now, that coverage has been pushed out into the end of January, middle of February, where all of a sudden, okay, I can kick the can through the holidays. I'm not worried about coverage because I have coverage now through February 1st or through the middle of February. And as much as I know I should be thinking about my Q1 needs, that still seems to be a moving target. And unfortunately, it's moving in the wrong direction where there just doesn't seem to be that sense, even though some of these items are back to pre-COVID type levels, and there's genuine value when you look at certain things. Like I've heard horrific numbers on 2x4 16s just because of the flood of euro out there, where, okay, I've been good deal to death. And when those churns slow down, you inevitably, as you can't churn stuff fast enough. And when you're fighting the last battle, it's very difficult to get people to think what lies ahead, because inevitably you will bottom. And we know what happens when we bottom, that everybody tries to race through the door all at once. And we'll see if, right now there doesn't seem to be a shortage of wood out there, but if everybody comes in all at once, does that change? And that's kind of
Well, look at OSB is a
what we need
perfect
to see.
example. OSB is a perfect example. It's hard to get a hold of it because there's 5 people really producing it, right? And a lot of it's on contract, and people want to do special deals with people and yada yada yada, right? So, but I'm finally starting to see a lot of bids come in on our platform for cars of OSB, and we're moving some stuff for people. So, you know, here's where the market's at right now. Here's what I uh here's what I see. I see uh people wanting to buy volume, people wanting to sell volume, but it's a pretty wide bid ask spread right now because everybody wants to buy pre-COVID lows and lower, right, on some certain stuff. But at least
Yeah, yeah.
the conversation is starting to take place, and we're
And
in the right area of the market where it should
in a
be.
grind it type market lower, everybody has expectations, and then as the market gets closer to what they expected, they lower those expectations to where instead of being a buyer at 350, nah, I think I'm going to go look for 330, 320, 310, 300. And I guess there's more comfort in necessarily, I don't need to be the hero and try to pick a bottom in a falling market structure. If the market's truly bottomed and I have to chase, then I think that there's more comfort in doing that. But when you look at, we've talked about housing starts and permits coming back down. Well, I mean, you look at lumber futures, you're back to March 2020 expiration type levels now, or within striking distance of those sub 300 lows. Again, personally, I don't think we're going to get down to these numbers, but could you get to 350 in futures? The big issue with January right now, is that you have, and again, I know we're going to jump around here, but I want to just get some of this in, and I'll come back to some of these charts. But when you look at the open interest and you look at the CFTC numbers, we've referenced this managed money short position, and the net takeaway is that there are X amount of shorts, cumulatively, you're probably around 1650 to 1700, because I think the funds have been selling the last couple of days. They're just adding to their March position, but it looks like a minimum of 2/3 of this short position is going to get rolled from January into March. And that's what you're seeing really the end of last week into this week so far. My count as of yesterday was around 1,250 rolls. You factor in today, you're well over 1,500 rolls. So where I'm going with this actually is that when you look at And let me go back to a January chart here. Cash legitimately is let's call it a 350. January has gotten up to 380.90 today. It's 373 last. You're not going to hold this premium in January should be trading at a discount to March. It should be trading even money. You're going to get convergence between now and to the end of the month, first week of January, once you're in the spot month. So the issue with January here is I would be very careful in buying this premium over cash. Cash is your best buy. And once these commodity funds stop rolling their shorts, you're going to have that come to Jesus moment with January, where if it truly belongs at a premium, then great, cash is bottomed, we're going to go higher. But if that's not the case, then the bottom can fall out of January to get to levels where it makes sense to buy that for delivery or buy it to EFP.
Where is 4-inch cash, the friend of a friend price today, Greg?
I think that I've seen blocks being done with a couple of majors out west in the 350-ish type area to the A-list crowd. But I don't think that like you waited a week, 2 weeks too long, and that the big buyers genuinely are gone for the holidays. And short of some kind of curtailment news or to shock the market here, this legitimately this is the wrong week. Next week is the wrong week to go find volume buyers because they're not working right now. They're done for the year.
Yeah, no, I do think that there are mills out there finding. I know on the east side and Spruce and some other things, they're going out and finding business and they're taking
Yeah,
it.
yeah.
And one of the interesting things though is I don't think there's a lot of I don't think they have a lot of dressed stock sitting there that they have to do. They've been doing a good job of keeping stuff moving all the time,
Yeah,
which is
and so that's my question is that, if the mills genuinely don't have big finished goods inventory at the mill level or at the reload level, does that mean that they're quietly bleeding out to some of the big nationals, and those big nationals are being satiated more than we think?
I don't think those big national guys have been buying anything. I think they
Yeah,
still have got the halt your buying. Right now until we figure out what kind of programs we're going to do with mills in 2023, which is crazy, right? Because I think they've been keeping him. It's been the right call so far. It looks like.
yeah.
I guess my question: what are the big trading houses doing? The big international ones that sit around and have to make money on something. Are they? Are they? Do they have a net short position this time? Are they sitting there, or are they just preserving all the capital that they also made the last 2 years?
Well, I think that in order to make money, they're legitimately probably having to take cash shorts because trying to buy a falling market structure is the death by 1,000 cuts. Is that you might be able to spin off their first 4 trucks, first 5 trucks, but it's that last truck or that last car that can slit your throat until we find a bottom. And that's the big issue. As much as I want to say I think we're closer to a bottom in futures, until you get stability in cash, it's going to be very difficult for futures to bottom on their own without cash bottoming as well.
How are
They
you
need to
seeing?
work in tandem here.
On that roll, and you, Mike, may have already talked about this. How are people rolling any of the old contract into new contract yet?
I think you're starting to get definitely when you look at I'm going to pull up open interest here. When you look at open interest, I think a week and a half ago, this was 300 to 325. So the answer is, yeah, you're definitely getting more interest to buy, March, May, really March and May. The difficulty is that when you look at, and I'm going to pull, give me 1 second. I'm going to pull up live quotes and I'll show you what the bigger issue is here. Let me pull this into the screen. So these are live quotes here. And so what you're looking at here, Ashley, here's your legacy contracts, January, March, May.
Yeah.
Again, okay, let's say that freight is $105. So the low in January was 62.40. The low in March was 62.20. You're carrying probably an extra $10 to $12 premium in these are the mini contracts right here. And so the difficulty is, yeah, I want to support the mini contract, but why am I going to overpay by $10 to $12 where every dollar is so critical in a falling market where, the reality is I have more interest in buying legacy. And then if I don't want that full exposure, I might hedge it in the mini contracts and pick up that $10 to $12 and then either trade out of it, leg out of it, or these are your conversion spreads right here.
Just a question, just a quick question. People maybe when I say old, the new contract, I'm not talking about months. I'm talking about the old CME contract versus
Yeah,
the new
yeah,
one. And the new one, first of all, I think Greg is talking about the premium it has because remember that is a truckload Chicago contract,
yeah, yeah.
basically.
So,
So
so, so I
the
mean,
number may be a little deceptive. I think what Greg is saying, if I'm hearing him right, is that new contract is a premium relative to what it should be
yeah, yeah.
versus
When I back out that, I think everybody that's actually traded it is using $100 to $105 freight to Chicago, and you can see. So like this is January conversion spread. So this is taking the mini, this is taking the legacy and converting it into a mini, and you can see today the trading range is $100 to 105, and that's where
Mhm.
that belongs from a conversion standpoint. But when you look at the low, again, the low in Jan today is 62.40. The low is 475. You're greater than that $105 differential. You're carrying too much of a premium in these mini contracts. So that tells me that there's less interest. Nobody wants to sell that premium. There's too many people trying to buy it in anticipation of what's to come. And so
Why wouldn't these big funds that are short want to roll and get that premium though?
I don't think it's on the radar yet. I think
They just may not know, right?
well, they may not know, and I think that you're going to stay where the liquidity, the volatility, you're going to stay where the liquidity is in the open interest. And right now, predominantly, you have more open interest, more trading volume, obviously in the legacy. So right now, the funds are rolling 85% of their short position into March. I think once you get into March, okay, you're either going to get one more roll into May. And so everybody is aware, there's no deviation from this. Come May 15th, legacy expires and is gone forever.
Yeah, and
There's no extension of this. You will have to trade the mini after May 15th.
I think one thing too, big companies that do programs with futures, I think they pretty much probably have guidelines where they have to stay in a known contract until they put new business on, and then they can go to a new contract. So my guess is if you have old business on in an old contract, you got to keep rolling that. And when you put new business on, you are just going to take it straight out in a new contract.
Yeah, yeah. No,
That's
I think that's spot on.
yeah, yeah, that makes sense. Well, cool, Greg. This really this helped get me get my head around this real good. Anything that we should be looking at going into the end of the week here? I know we're all our team is here in here calling and it's hit or miss. 50% of the people in the office, 50% out. But one of the thing is
Yeah.
people in the office generally this week are doing business, right? Because that's why they're there.
Yeah, no, I think there's been good trading volume in futures, obviously because of I think it's more role related. I would think that probably 90% of the fund rolls, when you look at open interest, Ash, I mean, you have 1468 left in Jan. After today, March officially becomes the front month as far as having greater open interest than Jan. And
Yeah.
I think by the time you get into the end of this week, the funds will aggressively, I think that they front loaded everything to be ahead of the holidays where they don't want to deal with illiquidity issues next week. So I would think that probably 90% of these fund rolls are done by the end of this week. And then January is going to have to stand up on its own two legs as far as does January deserve to be at a premium to physical cash? And the answer is probably not until cash can bottom out. And there's no sign yet that cash is bottoming. I think we tried a week and a half, 2 weeks ago. The inability to get random to print up on cash killed this market. And so now you have to kind of drift along and probably turn the page into Q1 and into January and get everybody back in the office, and then see how badly, how many guys truly have put off buying into the new year and are going to be guns a-blazing to come back in. But in a falling market structure, no one wants to be a hero here and step in and say this is good enough, because again, March, including today, I think we've made consecutive daily lows now, new lower lows in March, 4 or 5 sessions in a row. And January's done it now 2 or 3, I think 3 days in a row now, Friday, Monday, and today. So until you stop this pattern, that is the pattern, pure and simple.
So quick question here. Why don't mills and wholesalers, if I'm a mill, why am I not selling into January 23rd to deliver? And if I'm a wholesaler or mill, why am I not selling January 23 and deliver Hemfer into the contract and
Yeah,
ship
no,
that with at a
I
premium?
yeah, I agree. And we definitely had some wholesale distribution end users that legitimately have contractual obligations with sawmills based upon print. I mean, last Friday we printed at 360, and January was in that 390 plus area. From a basis standpoint, actually, so this is what I want to kind of stress. And let me go back to
Because I
so
think
so
everybody
here
knows
here
in that new contract you can deliver Hemfer into that thing.
yeah, you can deliver
Yeah,
hem
and
fur,
it's
Doug
not white
fur.
fur anymore. It's Hemfer. You can deliver.
It's as long as it's got a number 2 stamp on it,
Yeah,
deliver
it
it.
doesn't. It wasn't the old contract was relegated to about, I know because I did the map and I drew it all out. Like
Yeah.
6 mills could only deliver into it.
Now it's if you're a North American hem fur mill, got a number 2 stamp on it, deliver it.
Like if you're a big hemp fruit producer, you should really look at potentially what that delivery looks like into there. And
Yeah, yeah. No, I agree. And so the can you hear me? Do we cut out here? Ash, can you hear me?
oh,
Oh,
sorry,
there you
Greg,
go.
I
Yeah.
lost you for a second. It was
Yeah,
my
no, so
connection that went
all
down.
I was gonna stress is here's a weekly basis chart, and all basis is cash minus futures. And so go back to pre-COVID type levels. Look at your basis opportunities. You're talking about in a bear bull market structure trading 30 to 50 under, 30 to 50 over. We got accustomed to COVID having ridiculous bases that could go 150, 200 under, 150, 200 over. If you're going back to pre-COVID type levels, $30 to $50 basis opportunities are about as good as it gets. And so, my point is be willing to hit the singles and doubles here. You don't need to swing for the fences. And when I look at from a basis standpoint here, January, if you're getting contractual wood at 360, let's say print tonight's going to be 350. It's going to be 350 this week, and you can sell January at a $25 premium. You own the physical wood at 350. Can you turn around and sell that wood in the open cash market at 375, 380? I don't think so, because it's not on the ground. So why not sell January against that and go into the spot month and wait for the convergence to play out? Again, you don't need to capture 100 cents on the dollar. You can capture 80, 85 cents on the dollar. And then the flip side of that, Ashley, as March trades within, what cost of carry does March and May deserve over physical cash? If you're taking March for delivery, that legitimately is the last week of March, first week of April wood. If I can buy March within $10 to $15 of physical cash today, why would you don't have 100% of that cash outlay? You have the flexibility. All you have to do is finance the margining of it, but you've locked in those short jobs. You've built out your inventory within striking distance of actual physical cash. Again, these are the opportunities. As much as I want to say there's going to be this moonshot move back to 550, 650, 700, these are your opportunities right now. Deal in the reality of what the market provides, and the market is telling you from a basis standpoint, you're going to go, unless there's some magical change here in the demand supply structure, 30 to 50 under, 30 to 50 over is your basis opportunity, and use the basis to trade. This is where you're going to increase your margins. If you can capture a $30 basis at $350 wood, those are 9 to 10% margin opportunities. Are you making 9 to 10% trading physical cash right now?
So
The answer is probably a hard no.
Here's the crazy thing looking at that chart. The reason why you have those wild basis swings during COVID is because that's just the definition of volatility. And the crazy thing is, I bet you at 175, at 200, at $300, people were scared to death to put that basis on. I would be.
Well, I
right?
mean, again, when you're at these levels up here, this is where the mills will tell you that we don't need to hedge at $1,000. We don't need to hedge at $1,500. This is the paradigm shift. This is the new lumber. Now all of a sudden, we're here we are back at $375, and deal with the reality of today. I mean, this is what the market is today.
It's funny. I remember having shows a year ago, 6 months ago, a year ago, and everybody saying this is the new normal. It's like, hey, everything you and I talked about this 20 minutes ago. Everything always returns to the cost of production at some point, and test it.
You've said that since I've known you, Ashley. You've always stressed that, yeah. And so more importantly, newsflash, nobody cares what your cost of production is.
No, and it's not, and that it always sounds like I'm being mean-spirited saying that. It just isn't. It's just the way like I've worked on big trading floors. That's how they make their money, trading around the belief of everything returns to the cost of production, right? And generally, when it goes to the cost of production, it generally shoots through it and starts taking off high cost producers first, and you can and then lays its path for destruction. Then we start a whole new cycle over again.
Well, no, and you see that in other physical markets. You look at copper, how copper's bounced here. You look at crude oil market, whether you're looking at WTI or Brent crude. There's a reason markets hold these levels, because the producers say enough is enough. We're at levels where it doesn't make sense. We're going to do something about it. And I think, unfortunately, that's that's where we've turned the page from demand being the savior to where if you don't like these prices, then the supply side genuinely needs to take a hard look on the reality of what lies ahead and do something about it. If you don't like these numbers, then you need to take production off the market, pure and simple.
No doubt, no doubt. Well, Greg, look, I appreciate it. Thanks, great show. I think are you and Mike back at it next Tuesday?
Yeah, I think Mike. We talked about it. We'll see what goes on in the market here. Yeah, we can do a show next week. If not, we'll to be determined. And the other thing I want to stress, Ash, is that I know we normally cover a lot of other stuff, and it's in my slide deck. So if anybody wants that slide deck, just reach out to Ashley, Mike, or myself, and I'll email you the slide deck.
Great, thanks, Greg. Hey, if I don't talk to you, have a great holiday. And as always, really good information, my friend.
Yeah, likewise. Great talking to you, Ash. Take care. Happy holidays. Happy holidays, everybody. Take care.
You bet.